And welcome to this new format of Selfwealth Live Technical Analysis Edition. Look, I'm excited. I'm really excited to help present this new format of our show here. Now, the reasons why we're doing it is to educate clients on the other way of analyzing the markets and identifying opportunities. Now, we all know, well, a lot of us know there'd be a few ways of analyzing the markets, but the main two generally the fundamental analysis, which Owen Rast does a great job of on Wednesday nights live. But there's also the technical analysis, and this is what these shows are going to be based on, right? Now, based on a lot of user feedback, we know a lot of our community use charting and technical analysis to analyze the markets and look for opportunities. So it's a great way of finding trends and counter trends and learning how to invest and trade at the same time. But we also wanted to introduce a way of trading to clients that can be very systematic. Now, we know that society is very time poor these days, so these ways, technical analysis can certainly introduce ways of finding opportunities in less time effectively. All right, so now the format of these sessions, we're going to be doing a 12-week program to start off with. Right, we're going to learn a new principle and concept and apply it to the charts each week. It's going to be a question and answer style format. So obviously I'll be asking you questions. We're going to have a great host, the presenter beside me here. I'm going to introduce very soon. All right, and it's going to be a question and answer style where you guys can ask questions throughout, and we're more than happy to answer those questions at the end, or if it's a really pressing question, we can answer throughout to make it interactive as well. All right, so without further ado, I'm going to introduce Jason McIntosh. All right, his career began in 1991 at Bankers Trust in Sydney. Now, that must have been the days where they were just using paper to trade. But I wanted to make sure we got someone with plenty of experience in the markets when it comes to these topics, because look, I feel like you can get a lot of players out there when it comes to technical analysis. So I wanted to make sure I got the best for our clients to learn from. He founded a successful stock advisory and fund management business, and he's also now the founder of his systematic trading service called Motion Trader. So without further ado, Jason, I'm going to pass it on to you.
Roger, thank you for such a great introduction. And got to tell you, it's really exciting being here, to being able to talk about technical analysis over the next of doing this whole series with you. And like all those things I've learned over the years, trying to pass them down the line to people who are trying to learn about technical analysis. Maybe you already know quite a bit and just trying to fine tune things, get new ideas, new angles. So lots of really interesting things that we can go through. And just before we kick off, I'm just going to share my screen with you and the viewers. So just give me a tick while I find the right window that I need. And just before we start, just need to do our usual disclaimers that we do before these things nowadays. So this is everything that we speak about today is general advice. And so you can see there's a couple of disclaimers there. The first one involves myself and my business, Motion Trader. So I'm independent of Selfwealth, and I'm licensed under a business called Chartreuse Wealth Management, and their AFSL number is 422409, and you can read all that important stuff there. And so that's all about, so just wanted to pass on that little bit to start us off with, but just giving you a little bit of a background on myself. So, Rog, you explained that, I started off in the markets in 1991, and you mentioned, maybe we were trading with paper and on paper and everything. We weren't, probably wasn't that long ago, but I can actually give you a bit of a glimpse of it. This is my old world. This is where it all began. Now, see this young bloke here? That is actually me. It is around 1996, and so I'm 26 years old at this point, and I was on the this is the foreign exchange trading desk, this central part of the picture, and then as you look further back down, this is you're looking at the bond desk and the money market desk, options desk, And yeah, it's that classic trading room scene. And this was in Chifley Tower in Sydney, and the Bankers Trust dealing room. And look at those old screens we looked at. Those big box. It looks like we're all got microwaves in front of us. The way we look at screens now, the flat screens. But that was the scene. And it's really interesting when I look back. I look at a picture like this, and I think, like how do most of us learn about charts or trading or investing nowadays? And what we do, well, what most people would probably do, they'd read an article online, or they might go to YouTube and watch some videos. In the old days, we'd go to the bookstore and would buy a book. But then I think about how I progressed, and this picture you're looking at now, this was how I got to learn. It was the most fortunate start to a career in the markets, to be landed in this place straight out of uni. And so my mentors are people within this room. And so I got to learn their ways and find what worked and made their ways my ways. And that's really what this series is all about. It's passing on what my mentors taught me, passing those lessons down the line to people watching now. And my mentors learned their lessons from their mentors. And it's a whole series, the whole cycle. So that's how it all works. And it was really interesting. My graduate year was in the charting department, so this is where I get this fascinating with charts. It's just where I happened to start. There's a bit of luck involved with starting in the right place at the right time and learning the charts. And I just find it's a fascinating way to approach some markets. And hopefully the viewers are going to find this interesting over the course of the next few weeks, few months.
Thanks, Jason. Yeah, it's a great intro, and it's one of those things that, like, I can certainly relate. For me, I've been involved in trading the markets for about 7 years now, and technical analysis was a way that I didn't have to read all the company reports and all the news and understand all that, but was rather reading a chart which had all that information priced already into it, and also having a process orientated approach where I could tick, if A, B, and C was ticked, then I could put a trade on, make it quite simple. All right. So, but that said, let's get into this. Let's get into this show right now, where I'm going to start asking you some of the questions that I feel like a lot of beginners would be asking, right? And that is obviously, what is technical analysis, Jason?
Yeah, it's actually a really broad area. Technical analysis is not just one thing. So it really covers, at its essence, technical analysis is really looking at factors like price and time and volume. And it's there are so many different indicators when you look at technical analysis, and there are all sorts of methodologies. So using the term of a broad church, to say technical analysis is a broad church is really probably a good way to describe it, because it covers so many different areas. Everything from high frequency trading would come under the umbrella of technical analysis, through to people who look at lunar cycles. It's really wide, and there's some quite odd stuff in there, but there's some really important things, and they're the things that we want to go through over the next few weeks, where they're time-tested approaches, and which I use myself. I've seen used for decades, and some things which can really help give you an edge and help manage a portfolio. And I think because technical analysis and particularly charts now, we've got the internet, they're just so accessible. And so this means, like, it's applied by so many people. You've got people who are highly skilled, and also because it's so accessible, you get people who really they don't know the basics, and they find it really difficult. They're just drawing lines all over charts and don't really know where to take it all. So technical analysis is one of those things where look, there's a wideness in a discrepancy in the understanding of what it's all about, and this big variation in the quality of the analysis that you get. So I think the general theory, just going through the general theory of technical analysis, the general theory is that everything about a stock or about a market is already factored into today's price. And that's a really interesting thing to stop and think about. So you imagine all the analysts, all the investors, day-to-day people, everything what's known within the company, everything that's known about the company is currently factored into today's price. And this is why we're looking at how the price moves and the volume patterns that come into it, because as all the different aspects of what's known about a company comes in, the price moves around. And it's then a case of, like, when we look at a chart, we're analyzing the collective decisions of everyone in the market, and this is how we get to identify possibilities. And this is what technical analysis is about. It's not about predicting the future, it's looking at the possibilities based on what we're seeing in that price movement. So I describe it a bit like, when you look at a chart, you're kind of taking the market's temperature. Is the market hot? Is the market cold? Is it staying to warm? Is it staying to cool? We're taking the market's temperature. And this is a really important thing to do, because you don't want to be trading or investing in a market which is staying to cool or which is cold, because they're the times when you're more likely to lose money. You want to get into a market which is warming, or is even a market which is hot, because a hot market can run hot for quite a while. And that's when you can get some of the biggest trends. So being able to take the market's temperature by looking at a chart can really help you identify opportunities, and also identify situations that are best just to stay away from, situations which are just more risk than the potential reward of getting involved. And doing that, you just end up making more informed decisions. So technical analysis is really just another form of data analysis, and whether you're looking at a chart just visually, or whether you're putting the numbers through an algorithm, you're analyzing data. So we'll look at a few good ways, I think, to analyze some data.
That's really good, Jason. And there was a couple of key things that I think you said in there. And number one, time tested. All right. It's, for me, like whenever I wanted to get involved in something, it had to be time tested, right? Two, this technical analysis is a great complement to the fundamental analysis side of things. So like you said, if someone reads a company report and all that, they can get another opinion based on the charts. Just because a company report looks good, maybe the chart's trending down. So, it can give a possible other view, an objective view. So it's always good to be able to view two things there. And the idea, obviously is that it helps people make more informed decisions, right? And that's why I love the whole technical analysis, not only because it makes me feel smart to be able to read a chart, right? But so that said, Jason, what's the main difference between technical and fundamental analysis? What's the main difference?
Yeah, well, look, just really simply, fundamental analysis, that's all about trying to work out what we call the intrinsic value of a company. We're looking whether, is a company overvalued, is it undervalued, is it fairly priced, and it involves looking at the balance sheet, the income statements, looking at the economy. So looking at the management, what the management's doing. These are all fundamental ways of assessing a company and its prospects. Then we come to technical analysis, and we're not so much looking at balance sheets and income statements. Instead, we're looking at the company's price action. This is what we were talking about a little bit earlier. And we're looking for recurring patterns. Markets move in certain ways depending on where they are within their cycle, whether it's up, down, or sideways. So we're looking for these recurring patterns, which helps indicate where the market or where the stock may be within its price cycle. And there are all sorts of different approaches. There's not one special way. Like a lot of people, they they'll say, look, what's the secret? What's the secret to making money in the stock market? And I see I see promoters out there saying that they've got this special technique that the banks don't want you to know, or whatever it may be. But really, there's I think the biggest secret is that there's no great secret. There's no holy grail to technical analysis or fundamental analysis. There are a number of approaches under those umbrellas which will work. It's about finding what works for you. So many different approaches, and it's interesting what you were saying earlier about, like, you might look at a balance sheet and the company looks good, but then you look at the share price and it's in a downward trend. And that's, for me, that's one of those warning signs that maybe there's something that the market's not fully across yet, that is yet to come about. Really interesting looking at the stock market last October. So if we think back to last October, how bearish most people were, the bearishness was really off the charts, and it was considered almost certain there was going to be a recession. People thought that the stock market was going to go into a tailspin, and that wasn't the case. So if you're looking at the technicals, you could see that the market was struggling to go lower on bad news. That's a sign that all the selling, or most of the selling, has already been done. And it was a sign that the fundamentals, there were fundamentals which people weren't fully across yet, and that's become evident over the last 6-7 months. That the economy wasn't going into a recession, it wasn't going into a tailspin, but you could sort of get an idea that maybe that was going to be the unfolding scenario by looking at the flows on the charts. So my strategy is all about looking for price trends, and this is one of the things we're going to talk about a little bit more today, but then more over the next few weeks. Looking for those price trends, like how do you get into a stock that starts to rise today and then might continue to rise over the next several months, over the next year or two, and then staying on board? How do you maximize your profits with a price trend? And how do you assess when a price trend has turned, and when should you exit? Because a mistake a lot of people make is they may get a good trend, but then they ride it all the way back down at the bottom because they struggle to see that change in trend. So these are all the things that we can do with technical analysis. And another thing, it's not an either or situation. You don't have to be a fundamentalist or a technical person. What I do, I focus on the technicals, but I know other people who will combine the two of them. They'll look at the technicals and find, because technicals are really good for identifying a whole lot more opportunities than you can fundamentally, because I can look at a chart and assess it in 5 seconds, but I can't pull out a balance sheet and tell you anything in 5 seconds. I wouldn't even have time to turn the first page. So technical analysis lets me cover a lot more ground. I find the opportunities, and then people who want to do fundamental analysis, they can then get a hot list or a short list of stocks, and then they can do the fundamental analysis, pull apart the balance sheet, and maybe find some stocks, some ideas they've never heard of before. So yeah, some really interesting aspects to technical analysis where the two can be combined with the fundamentals, or just like me, maybe some people just want to be technically orientated. Really works. Depends what works for everyone.
Yeah, like you said, Jason, it does. It just really depends on what works. Like for me, it's like I do the technicals, and then I might quickly review the books, right, just to see if they're But it's what works for everyone. But to the other point, I just want to say to our clients as well, who might be a beginner at this. Yes, this can take a long time to learn these approaches, right? But I think the value is in understanding that it's not that complicated. You don't have to be a data analyst. You don't have to be a data scientist. You don't have to be someone who has to understand numbers. It's more about just learning and then applying, and that's what we're going to do, in this whole series, which is going to be great, because I know you were a guest of Owen's last year, I think, or at the start of the year, I can't remember, but it was like an intro session once again, where you don't really get to see everything. Whereas this next 12 weeks, I'm I'm super excited to be able to teach our clientele. And even if you've been in the TA game for a while, I'm sure you're going to learn something or two from Jason. So my next question for you, Jason, is can technical analysis be applied to any financial markets, or are they sort of more specific to certain areas?
Yeah, it's look, I think it's a case of I think technical analysis can really. This is one of the great things about technical analysis, is that it allows you to look at all sorts of stocks, all sorts of markets that maybe you don't have a whole lot of idea about. It really does allow you to broaden your investable options, because you don't need to be an expert on the underlying factors that may be important to that particular stock or that particular market. So, for instance, I might be looking. One of the areas I'm looking at the moment is uranium and uranium stocks. Now, I don't know a whole lot about uranium, and I don't know the ins and outs of uranium mining, but I know what a high potential chart looks like and a chart structure looks like. So if I was relying on my knowledge of certain areas, I'd be a lot more limited in what I can look at. But because I'm looking at price action and price data, it opens up my scope of where I can go looking for opportunities. And it's a case of, I think, look, what I do, I'll show you some examples. I'll show you what I mean. Let me just switch between my screens here. I'm going to go to my charting screen, and I've just got a little bit behind the scenes navigating to get to the right place. Here we go. All right. So this is what I mean by like being able to have a broad scope of what I look at. So I use a trading service called TradingView. Really good for getting charts from all over the place. Covers all sorts of individual stocks from different countries. You can get UK stocks, American stocks, Asian stocks, Aussie stocks, of course, all sorts of different markets. Looking down here, this is just some of the different markets I cover. So these are all US indices. So this one on the chart at the moment is the S&P 500. I've got some lines already drawn on because I talk about this in my weekly video series, which I do on YouTube. Got some support and some resistance, some more support there. I've got some moving averages. Talk more about this stuff another time. The point here is just to look at like the broadness that I can cover. Then I come down. I've got the local market. Come down. I've got some international markets. I've got the Europeans. I've got the Canadian, the Japanese, Asian. Even though we go down, I'll look at some obscure, what people would consider obscure, like Turkey. Like I've got an ETF on the Turkish market here. Like I don't know much about the Turkish economy. I know they've got some inflation. Their currency hasn't been doing well, but it's a place where you can get some good price trends. And it's interesting. I was just looking at this the other day, and so I've just changed it over to a weekly chart. So this is a weekly chart of this Turkish index. And look what I can draw here. I can draw in, and I'm going to talk about patterns like this another time, another day in more detail. But just to give an idea of like how I can look for opportunities, I'm drawing this downward trend channel. And what's interesting with a trend channel is they're really worth watching when you start getting these basing formations where the price stops going down. Then you get a breakout. And we've had a run, we're getting a consolidation. So it seems to me this could be setting up for another leg higher. Now, I know nothing about Turkish stocks, but I can see opportunities in these price action. And then we go further down. I've got bond markets from around the world. I've got some I've got the currency markets. There's the Aussie dollar and so on. Copper, gold, uranium, it's all there. So this is what you can do when you've got when you're able to look at a whole range of markets, and so you can apply it. You can apply technical analysis to all sorts of markets, and you can find interesting opportunities which otherwise might have missed.
Okay, great. Thanks for sharing that. And I guess this is a couple of questions on the channel here, which we'll just break it up and answer here. But you've got obviously a stock there, which is to do with Turkey, which is actually on the NASDAQ, should be tradable on the Selfwealth platform there, as we obviously trade US stocks as well. But as like to your point, yeah, it's not just for a ASX market. It's for all the stocks and all the indices and forex markets, and anything that has price data can basically, you can do technical analysis. And it's amazing over the years, the repeatable patterns I've seen, that just shows that it works, right? So yeah. the other question I've got here says, can you do basic with Selfwealth chart, or can I do the basics with the Selfwealth charts? There is charting on the Selfwealth platform. Obviously, if you go in and you can sign up for free and try it out, there's a sort of a basic version, then there's an advanced version. But the software, someone else has asked, is what technical analysis software would you recommend, Jason? Obviously, you're using TradingView there.
I think there's a lot of stuff you can get, and it doesn't need to be expensive. Like TradingView, I can't remember offhand, but it might only be costing me $100 or a couple of $100 or something like that for a yearly subscription, and so it's really affordable. Very different. I remember when I came out of Bankers Trust in 1999, BT had just been bought out by Deutsche Bank, and I was off on my own. I was made redundant at that point, and it was like, well, what am I going to do now? And I wanted to set up my trading operation from home. Getting a charting service at home in year 2000 was going to cost something like $2,000 just to get the software. Then you had to pay for the data feed. It was basically unworkable for most people. The only way you could really trade was to be in a financial institution. And very different situation now. You can get like the TradingView stuff, which I've just had up on the screen. It's better than the stuff I was using in the bank back in the day. And this is only costing a couple of $100 a year. And the other thing I think which is lost on a lot of people is that you don't need a million indicators. Keeping it simple. That's what I do. I keep it simple. You only need, really, if you said to me, Jason, if you can only use one indicator, can you trade, and what would it be? And the answer is, yep, I could trade off one indicator, and that indicator would be a moving average. And you don't get much more simple than a moving average. You don't need 30 indicators on the go. Don't need to make it complicated. And this is a great thing about technical analysis. It's easy to understand. Not necessarily, and I want to make a distinction. It's not necessarily easy to apply. Well, it is. It's simple to apply, but to apply well. It takes time, and it takes practice, and it takes dedication. Like anything, you want to do anything well, you're not going to. These people, they come online and think they're going to be experts tomorrow and make a lot of money. It doesn't kind of work like that. It takes a lot of time to get good at anything, but the principles are simple to understand. You don't need a degree in rocket science or anything like that. It's they're simple to understand principles, and they're repeatable. This is a big thing. You're looking for things which are repeatable, like getting a tip from your mate at the pub. Not so repeatable. Looking for a chart structure which you can see has occurred over. You pull up a chart from 100 years ago, and you see that same chart structure. You go, oh, look, there it is again. The market's had a run and it's gone into a sideways compression band. We'll look at examples of all this as we go through the series, and you go, look, that's one of those patterns again. We've seen this millions of times over the years. Here it is again, and you can. We're looking for asymmetric. It's one of the things I like to always talk about. Asymmetric risk-reward situations where your upside. We'll start with the downside, because that's where you should always start when you're analysing a market. Look at your downside, where I want to look for situations where my downside risk might be, say, 1 unit, but my upside potential is 3, 4, or 5 units. That's what we call asymmetric risk reward. That's how you want to play, and we can use technical analysis to get that sort of setup, and that's really exciting. That's one of the most exciting things about technical analysis. I think it's harder to do fundamentally. How do you look? Maybe you can do it fundamentally. Warren Buffett talks about buying something that's worth $1 for 50 cents or whatever it may be. So you're looking for that. That's got that same asymmetric aspect to it, and we're trying to do that with a chart. We're looking for trigger points for entry where our risk is relatively small and our upside is great. That's what you want, and you want to repeat that process consistently over time. And you're not going to get a win every time by any stretch, but over the course of a market cycle, you can get some really good performance when you're applying a systematic process consistently. And
Yeah, I think that's the perfect way to look at it. More upside than downside, obviously. So do you think technical analysis is more suited to short term versus longer term, or both? What's your take there?
Yeah, I think it's a really interesting question, Rog. It's I'm going to share my screen again. I'll go back into screen share mode, and I'll just show you some examples. So I approach what I'm doing at the moment. So I've done this from both perspectives. I've done short term and I've done longer term. At the moment, or for the last several years, my focus has been on the longer term. So when I say longer term, I'm looking at the moment. I look for stocks which, and through my motion trader service, I'm looking for stocks which have the potential to do well over the next 1 to 2 years. So I'd say it's more about, for me, it's not about. It's about the active management of a portfolio or portfolio of stocks over the like a 1 to 2 year potential time frame. Now, this is an example. This is a stock I've actually got in my own portfolio. It's a company called Duratec. Now, I'd never heard of this company when it first turned up in my signals. So I'm using, with what I do with my motion trader service, this is where I'm using data, and I'm putting data through algorithms, and the algorithms are looking for the momentum-based traits of a stock which could be entering an uptrend. So I've used those old rules I've learned through classic technical analysis, and I've converted into computer code, really, so that I can cover more ground, I can scan more stocks. But it's using those same tried and tested and time-honored principles. So this stock called Duratec turned up, and it's currently got a market cap of about 300 million, and they do something to do with concrete and steel remediation. So I'm not really that up on what they do, and that doesn't really matter to me. I'm not so bothered about what they do. It's more about looking for stocks which have that asymmetric setup that we spoke about. Now, let me just I'll just get a bit more data here. So you can see this stock had done nothing. So this is June 2021. This stock did nothing all the way through for the 6 months into December 21, coming into 22, did nothing. There's mid 22, still not doing anything. Then in the second half of 22, the moving averages turned to the upside. Let's come back a little bit more. You can see these moving averages have crossed. I'm using a 50 and a 100-day moving averages. I'll talk more about moving averages another day. 50 and 100 days aren't magic numbers by any means, but they're good for medium-term trending situations. So the moving averages cross, then you can see we get a break upwards in the share price, and that's a momentum sign. So I'm looking for momentum in share price, and that's like this is a technical it's a technical screen for momentum. So I get this upward movement in the momentum, and that was a trigger to buy. The stock then went sideways for a couple of months, which often happens. Then we get another move upwards, and then you can see we get another sideways compression. These are the patterns I love looking for, where you get an up move in a stock, and then you get a sideways compression. And it's interesting. I'm going to show you a shorter term chart in a minute. You'll see the same sort of formations. Comes back to the moving average, rallies again, another sideways compression, more momentum, and that continues. So this stock is up something like where was the entry? The entry is at around 44 cents. It's now $1.20. So it's done really well. And you know what the market's been doing over the last 10 months or so? It's been pretty unpleasant. So an example where we've used technical analysis to find a stock which almost nobody's heard of, which has then gone into a smooth upward trend. So that's an example of looking for using technical analysis for medium term or longer term investing. And I'm collecting dividends on this stock as well. So it's not all just about day trading stuff. Technical analysis isn't just for people who want to sit in front of a screen all day. It can be used over these longer time frames. Now, let me show you. I'm going to go back and share a different screen now. So let me just do a bit of jumping around on the controls behind the scenes, which you guys can't see. And I'm going to go across to, this is the ASX 200. And what I want to do here, so this is a daily chart. So this is a daily chart of the ASX 200. And the last 4 months, you can see we've just been in this tight range. I've got some resistance marked on the top there. I've got some support down here. Again, things for another day. But you can see, generally speaking, this has been a pretty tough period. You say, well, look, there are no trends there. The moving averages are going sideways. There's nothing to see. Depends on your time frame. Now, if we click this down to, say, an hourly chart, this all changes. So what seemed like a market which was just going sideways and doing nothing, we've got these great trends start to appear where you get moving averages cross, and this is a tradable move. To buy ASX 200 through, like, could be through a futures contract or a CFD, and there's a tradable trend there. And we can, when I get my internet back, we can scroll this across, and there's more of these moves. Again, a nice clean trend. And we can also go even further. And this is one of the things I used to do at the bank. I'd use 15-minute charts to trade off. So I'd be sitting in front of the screen all day. So this is what you do when you're looking at a 15-minute chart. This is someone who wants to sit in front of the screen all day. And in my 20s, I thought that was a great thing to do. And I still find it fascinating. I just don't have the time to sit in front of the screen all day. This is just last week where it appeared it was like pretty untradeable conditions. I got a nice moving average cross, had a falling market. Here's that compression zone. We talked about compression zones on that chart for Duratec, which was a daily chart. And this is on a 15-minute chart. You can see a fall. You can see a compression, then you can see another break to the, in this case, to the downside. Looking on an upside, which probably makes more sense to most people. We've got a strong move up, and there's that sideways compression zone there. This is a technical pattern, a repeatable pattern that it can often lead to great results. Breakout, and then a run. So yeah, look, just an example how you can use technical analysis over those different timeframes.
Yeah, well, they're great examples, and like you were saying, right? Yeah, you can sit in front of a chart and watch it for all day long. But I'm sure a lot of our clients, while they might do day trading, there'll be a lot of that do day trading actually, because they're quite the split camp, right? But the point of these series as well is just to show people how you can identify opportunities that don't take all day to sit in front of the screen, but they might take 5-10 minutes in the morning just to check some charts, right? And see what's available. And the other thing I wanted to mention was in terms of short-term trading and long-term versus long-term, one of the things I'll always remember someone telling me about is whatever you see on a long-term chart, the same patterns happening within that short-term area, and they're called fractals. And I don't want to get onto it. Maybe I haven't explained it properly there, Jason. Maybe this is a topic for us, but fractals. So you'll see the same patterns happen in a 15-minute chart than what you'll see over in that same day period, right? And I thought that was really, really interesting. If whether you wanted to do short term or long term, all right.
And that's exactly right. So that's what one of the things I was showing on that chart of the ASX 200, where you could see the market would rally, and then it would go into that tight compression band, very much like we could also see on a daily chart of a stock. And it's interesting, that stock called Duratec we were looking at. So I bought a position in that. I can't remember when. It might have been sometime last year. I've done nothing with it since, other than sit there, and it's now up 100 and something % of my portfolio. So I've done nothing other than just periodically monitor that it's still above the above the trailing stop.
Yeah.
And and this is what gets back to what I was saying early on when we started off, is there's not one single way to do this. There are many different ways and there are different approaches, and it depends what the individual wants to do. If someone wants to be a day trader or an intraday trader, well, you can take technical analysis there. If you want to be more medium term, more position orientated, where you're holding up a stock for a couple of years, but you want to have the skills to be able to identify more opportunities, and then you want to have the skills to say, like a lot of people will say, I buy a stock, but I just never know when to get out. But if you have a good understanding of some technical approaches, that can be your method for always having a way to get out. Because one of the worst things that can happen is, and I've heard so many stories of this, where people will get a 100 or 200 or 300% gain in a stock, and then they'll ride it all the way back down to not just where they got in, but below where they got in.
Yeah.
Because it's like, well, okay, well, I'm up 300%. There's a pullback. I'm now, I'm now up 250%. Well, I don't want to sell now because I was up 300% not long ago. So I'll hold on a bit more. I'll wait for it to go back. Then it's down 200%. Well, I'm not going to sell now because I was up 300%, and it continues. Well, now I'm only up 50%. Well, now I'm definitely not selling. The next thing, the stock's delisted because it was a .com stock, or it was a mining boom stock, or it was a lithium stock which turned out to have no lithium, or whatever the story may be. You've got to have that method of getting out when the trend or the situation changes. And for a lot of people, sadly, they just don't know what to do. They get frozen with fear. But you've got those technical underpinnings, some systematic. And this is what it's all about: systematic. So you don't need to think so much about it. You just do. You follow your process, follow your rules, follow the method. You're out, and that's really important.
Yeah. And that's why this series is going to be great for even those people that do enjoy the fundamental side of things, right? Because like you said, most people, they know when to enter, but they don't know when to exit. So this might give them an option. It might give them a strategy when to exit a trending stock, right? So it's good that way. I think we'll wrap it up there, Jason, for this week. There's a couple of questions. One question specifically here from someone here about the moving averages. Do you use moving average crossover as an indicator? Obviously, you use moving averages. If so, what SMA time periods do you set? SMA time.
Yeah, so SMA is a simple moving average, and as opposed to an exponential moving average, which is an EMA. The difference between the two, you just Google them to get an explanation. But an exponential moving average just gives a little bit more weighting to the most recent data. So it's a little bit more responsive to the price action. They both do essentially the same job. I use 50 and 100 days because I'm looking at that medium-term time frame. I think 50 and 100 work really well for where you don't want the moving averages to be too reactive, because if you're looking for stocks which might do well over a 1 to 2 year period, maybe a stock's been in a downward trend, and you're wondering, okay, when's the time to buy? If you're using, say, a 20 or 30 day, a stock in a downtrend just could have a multi-month rebound, bear market rally, and the 20 and 30 day averages may cross, may get you in, but then it continues in its downtrend. So I like that 50 and 100 days. They're less responsive. Of course, it doesn't guarantee that they're going to give you the right entry point. But if you want to, and also the longer moving averages create less turnover. So if you want to be less active, you don't want to be having buying and selling as frequently as using shorter moving averages. The 50 and 100 work well. That said, there's nothing wrong with using a 20 or 30 day average. Maybe you want to be more active in the market. Maybe you want to see opportunities occur more frequently, and you're not worried about getting some more false signals when they cross and then they turn lower again. So, like anything, there's no holy grail of this is a combination to use. It depends a lot what you want to do. It's for me, medium term trends, 50 and 100 work well. You want to go a bit shorter, 20 and 30, for instance, can work well, or maybe it's 30 and 50. There's no special mix. Make them too short, it's like it just doesn't. It really does start to come apart. You're just getting signals everywhere. I think for me, 20/30 would be the lower end.
Okay. No, certainly. I think when I first started trading, they were teaching me 8 and 20. I think they just wanted me to do volume versus actually win. So,
even on a 15-minute chart, I wouldn't be using an 8 or a 10-day moving average. It's not days then, it's period. So if the moving average will adjust to whatever the period be. So if you're looking at a 1 hourly chart and you put on a 100 moving average, it's a 100 period, so it'll be a 100-hour moving average. Or if you go to a 15-minute chart, it'll be like 100 periods within the 15 minutes. But look, even looking at a 15-minute chart, I'd still be looking at there could be a place for a 20 or 30 period moving average to get some of those nice. Like you might remember that ASX 200 chart we saw here. You could see the price was traveling above the moving averages. By default, that was showing you a 50 and 100 period moving average on those short-term charts we looked at. So they were very tradable moves with those longer period moving averages. So I think don't be too quick to go, well, I want to get really early signals, so I'll go for really fast moving averages, because you'll get a lot of chop and a lot of false signals. So just the whole idea of moving averages to smooth out the price. If you have the number too low, you're not smoothing very much. You're just really just getting the price.
Yeah. Question here: do you trade with leverage?
Not at the moment. I did when depends what I'm doing. If I'm trading futures contracts, I'll be trading with leverage because that's how they're constructed. And so I've done a lot of trading with futures. So I've done a lot of trading with leverage. The portfolio which I run now, so I run so I've got my Motion Trader service, and I also run my run a family portfolio on the Motion Trader service signals, and so that's unleveraged. It's it's like a $1 million or something portfolio, and it's just an unleveraged portfolio because I don't need to use leverage with it. Leverage scares me a bit. Like, I'm a bit risk averse. Some people think that's a bit of a funny thing for someone who been trading markets for 30 years to say, but maybe that's why I've been trading markets for 30 something years, because I am a bit risk averse. I think a lot of people come in, they use too much leverage, and leverage is a great thing when it's working for you, but it can be an absolute disaster when it goes the other way. And the number one rule of trading is you've got to stay in the game. Staying in the game is number one. If you lose too much leverage, you're out of the game. So there's a great quote. A guy called Larry Hite. He's one of the pioneers of systematic trading, which is like doing what I do in terms of like we're using moving averages and looking for trends. He said, if you don't bet, you can't win. But if you lose all your chips, you can't bet. So it's a lesson on leverage and control of risk, respect of risk. So we can't be so scared of risk that we can't put on a position. I see that people will say, "Oh, the market's going to crash, so I'm not going to do anything." But if you've got opportunities, you've got to be able to get past your fear, and you've got to be able to move forward. So you've got to bet. You can't win unless you bet. But if you go crazy with your bets and you go all on black, what's going to happen? You're going to lose all your chips. If not this trade, next trade, or the one after, but it will happen. So there's nothing wrong with leverage, but I don't need to use leverage. I'm not using it. But if you do use leverage, completely okay, but just keep it under control. You can't. There's a certain point where it becomes just too much. Maybe it's only. Look, I don't know. I won't say offhand like what's the right amount of leverage, because I don't know for the situation. But yeah, too much leverage only leads to bad things.
Yeah. Well, that's I think that's obviously a good tip at Selfwealth, we only have physical, tradable stocks, ASX, US, and Hong Kong stocks. We don't use leverage. Part of the sort of the ethos at Selfwealth as well. We don't want to, put more risk on our clients than what they may already face. So, I think that's a smart, common sense thing for now. Nothing wrong with it if you want to go down that track, but we're not going to be sort of educating people on leverage just right yet in this series, that's for sure. So, I think it's a good start, Jason. I really appreciate all the knowledge and time, and I'm looking forward to really applying more of the concepts and principles to the charts themselves. That's what the point of this. So going forward, we're going to talk about principles. We're going to be applying it to the charts and getting right in there. All right. But before we do that, it's a really important topic. It's going to happen next week, and that is trader psychology. So next week, we're going to be talking about trader psychology or investor psychology, whatever you want to call yourself. Because for me, it's always, for anything in life, right? It's always 99% psychology, maybe 1% how to or technicals or whatever you want to say. So understanding the psychology behind it is important, right? So that's what we're going to be getting on to next week. And just as a reminder, obviously none of the stuff we say here is personal advice. It is all just general in nature. We don't know your circumstances, so please make sure you do your own due diligence there. One of the other reasons why I got you, Jason, is because people can always go visit you online. They can see what you do. They can see your portfolio, as you've mentioned, and they can see how technical analysis works. All right. So, but other than that, anything else, Jason, you wanted to mention?
No, look, look, I've really enjoyed coming and having a chat today about all these things. And Roger, always good talking with you about technical analysis. It's fun talking to people who've sort of like been on this journey of looking and building the skills and just talking about things that have worked, things that don't work, and trying to learn about the mistakes that people make, and we can be aware of things that don't work. Like, learning through others' experience, I find, is always better than trial and error. Trial and error works, just takes a whole lot of time, and you can go through a whole lot of unnecessary pain. So I can share some experience which can help fast track what people might want to do themselves. Well, that's terrific. I'm really pleased to do that, and happy to be here with you each week doing it.
Fantastic. All right.
People want to see me apply technical analysis on a daily basis, just come to my YouTube channel. Just type in Motion Trader on YouTube and find my channel. On each Saturday, I put out a video just talking about market outlook, looking at the S&P 500, the ASX 200, and gold and uranium, copper, all the stuff, just applying some of those principles that we'll be talking about. So it's always good. Principles are great, and they're important to get your bedrock of understanding, but then you want to see them being applied as well. And that's where I do that each week.
Yep, definitely. So just search Jason McIntosh. I'm sure there can't be too many of you out there with your experience and good looks, Jason. So all right. Well, I wish you thanks everyone. Thanks for coming and listening, and we'll see you all next week at the same time.
Good one.
Take care.
Thanks, Roger. Thanks, everyone.
All right.